America is home to 33 million small businesses, the beating heart of communities across the country.
And proof that the American dream is still alive.
This is a show about those dreamers and doers and the communities they serve.
Their real life stories.
Their struggles and successes.
Their grit, determination, and passion.
And the people who fight
to keep their American dream alive.
I'm Alfredo Ortiz.
I'm Elaine Parker.
And it's time for another episode of Main Street Matters,
America's small business megaphone. Hi, everyone, and welcome back to another episode of Main Street Matters. I'm Elaine Parker with the Job Creators Network. Corporate America didn't suddenly go woke. It was pushed there. ESG and DEI didn't emerge from consumer demand or shareholder votes. The Heritage Foundation is now flipping the script on the same shareholder tools that the left used, only grounded in fiduciary duty. Alan Mendenhall is a senior advisor for the Free Enterprise Initiative at the Heritage Foundation, and he's joining us today to discuss this issue. Alan, welcome to the show.
Well, thank you very much for having me. This is an exciting project we're working on.
Well, tell us about, let's start with what ESG and DEI are, and then let's get into the project.
Oh, wow. I could talk about this for a long time. So ESG is, the way I define it, the non-financial standards and practices that asset management firms, proxy advisors, financial institutions, accountants, etc., use when they allocate capital or assess risk. So the operative term there is non-financial standards. So the acronym E is environmental, S, social, G, governance. E involves all types of stuff like biodiversity loss or net zero by 2050 or greenhouse, all kinds of greenhouse gas emissions, etc. Social is where you get that DEI prong. I always fold DEI into the social, which of course is diversity, equity, inclusion. What I always tell people is that term is very misleading because diversity actually means uniformity of thought. Equity means unequal treatment of views, people. In fact, it means typically discrimination on the basis of race. We can go back to that. And inclusion usually means exclusion, excluding people who hold to particular religious views or particular ideas that are considered outside the scope of left-wing thought. So that's DEI. Now, the G prong, it refers to a lot of things that are pretty standard fare, transparency, accountability, board composition, those types of things. But big picture, what the G really represents is this shift from the shareholder model of corporate governance to the stakeholder model of corporate governance. So historically, and as Milton Friedman wrote famously in the New York Times in the early 70s, the purpose of the corporation was to maximize profits for shareholders. Pretty simple. That didn't mean corporations didn't do other things. Corporations added a lot to society. They added value. That's in fact what profits are signs that you've added value to society. They employed people. They provided goods and services. They contributed things that made our lives better. They innovated. Corporations are already great things. But when you go to the stakeholder model, historically, stakeholders were defined as basically your consumers, your employees, people in your supply chain. And of course, every good business, when they follow the shareholder model, trying to maximize profits for shareholders, they have to do great things for those particular stakeholders. Otherwise, they don't make profit. But what ended up happening is the term stakeholder began to be defined very broadly to include things like the environment or society writ large, these amorphous categories with no concrete referent. And that enabled corporate executives to get away with a lot of nefarious stuff, because if your business purpose is not profits, which is something you can measure numerically, empirically, but it's to help society or to improve the environment, then as an executive, you could say, well, we didn't earn as many profits this year, or we were down, but that's not our core business purpose. Our core business purpose is to do this or that for society. And look how well we did there. Who cares if we, so it really enabled some bad actions by corporate executives.
So essentially, these large asset managers, when it comes to making investment decisions, they were looking at I'm going to be super simplistic here, but they were looking at how well a company recycled, or making sure that they hired, the diverse workforce that they thought was important, that they prioritized, and not whether or not they were making a good product, being a good corporate citizen, and growing their company, in a obviously in a way that helps society, but growing their company and being a good corporate citizen. They were looking at extraneous things that didn't lead to maximizing shareholder value, which is what they have a fiduciary duty to do.
Correct. Yes, that is all correct. And it wasn't just the big asset management firms. They get a lot of attention. BlackRock, State Street, Vanguard. Actually, Vanguard has done a lot of good stuff lately over the last 2 years to walk away from ESG. So of the big three, they're my favorite right now, and State Street is my least favorite of the three right now. But at any rate, it's also the ratings agencies like Sustainalytics or something, or the proxy advisory firms, ISS and Glass Lewis. But if you wanted to get bonus points for ESG, if you wanted your ESG scores to be really good, you might do something like, say you're headquartered in a red state, you might pay for your employees to get an abortion out of state. Or you would have DEI embedded within your governance structure. You would have a diverse board. You would have all these kinds of things. Or you might provide puberty blockers for children of employees as part of their healthcare package. Things like this would be good under ESG criteria. Fortunately, we're in an era where we're starting to push back against this, and everyday discourse is recognizing that these things existed. I think a lot of consumers, a lot of people throughout the United States had no idea that this stuff was going on. And now that they're waking up to this reality, they're getting mad. But you're right. The big three asset management firms are still big problems, because if you look at any ticker symbol in Yahoo Finance, so I came from a business school. I actually came to the Heritage Foundation from a business school. And I used to do this activity with my students. And I used to say, pick a ticker symbol on Yahoo Finance, anyone, and go look at the holders. Chances are one of the big three will be the top holder. And in fact, presently, those big three constitute about 88% of the S&P 500s as the largest holder, and 88% of the companies. And so it takes students a long time to go in there and find a ticker symbol where one of the big three isn't the largest holder. If you account for the 5 largest firms, then it's basically 100% of the market owned by 5 firms. It's a crazy concentration of power, especially when you take into account like a company, for example, BlackRock. BlackRock owns shares of companies that own shares of BlackRock. BlackRock is the largest shareholder in companies that are direct competitors. So BlackRock has this insider information about competitor X and competitor Y, and is pushing those companies to make important business decisions with knowledge of the inner workings of both. And that creates a very dangerous conflict of interest. So the concentration of power issue aside, there are all these other dynamics at play that really implicate historical business ethics practices.
So when Job Creators Network was first formed by our founder, Bernie Marcus, what he wanted employers to do was educate their employees about how public policy impacted the company's bottom line. How did it impact jobs? How did it impact their profitability and their how they could grow based on the policies? More regulations made it harder. Higher taxes made it harder. You know the drill. And we put it into educational materials that were, probably high school level, easy to understand. We weren't pulling out balance sheets. We were just sort of talking from a lemonade stand point of view, right? So we've always taken the position with all of this woke and DEI and ESG is that these corporations, these companies should not be stepping into the cultural battles happening. You mentioned abortion, you mentioned puberty blockers. I mean, those are things that have nothing to do. And I'll use, Disney as an example and what we dealt with them a few years ago, right? stepping into this parental rights law that the governor of Florida was passing, and Disney said, we're going to take this to the ends of the earth and fight it in court. And all I thought was, your mission says that you're here to entertain families and children, not step into the cultural divide of America, because all you do is alienate one side over the other. But I do still think that companies have, stemming from our inception from Bernie, have the obligation to speak out on financial issues and educate their stakeholders, their shareholders, the media, members of Congress about how policy will impact their ability to compete and thrive and grow. So if there's a bad tax policy, and they're going to raise taxes in your industry, in your corporation, you need to speak out about that. You have a fiduciary duty to speak out. You have a fiduciary duty to talk to your employees and tell them, hey, I'm not telling you who to vote for, but I'm telling you if this law passes, I'm going to have to make these changes in our company, which will affect you as an employee. So you need to understand that connection. I feel that's their obligation and duty to speak out in the media on those issues. When it comes to the other issues, the cultural wars that we have going on in this country, they should be as quiet as possible and not say a word. And it should not be stemming from their boardrooms. And that's where a lot of this is stemming from, isn't it? And this cancer is inside these boardrooms, right?
I think that's partially correct. A lot of these boardrooms are under pressure from these institutional investors, some of which are activist investors whose sole purpose in buying shares of the company and waiting a year to engage is to push the company to the left rather than helping the company improve its business. But you're right about these social issues. They create reputational risk. Great examples are what just happened with Cracker Barrel, Anheuser-Busch, and the Dylan Mulvaney Bud Light situation. Target, when Target was putting LGBTQ plus materials in the children's section, and things like that had terrible consequences for the company because the company alienated its chief consumer base. And if you think about it, if you just hypothetically say, okay, exactly half of America is conservative and half of America is on the left, just hypothetically that it's directly half and half, why would it be a good business decision for a corporation to alienate half of the people in the United States? It's a terrible business decision. And the reason why companies do it isn't because it's a good business decision, but because it turns out a lot of these institutional players, like the big asset management firms, like the proxy advisory firms, ISS and Glass Lewis, are terrible. They are the ones that push these companies in the direction and that make boards populate with the types of people who are more amenable to these left-wing viewpoints, because it becomes, under ESG criteria, somewhat dangerous to hire a conservative, because then, what if ISS and Glass Lewis recommend voting against whatever it is on our proxy statement because they have a conservative male on the board? That kind of stuff is dangerous. Fortunately, we're seeing a move away from ISS and Glass Lewis, as JP Morgan Chase just announced that it's going to stop using proxy advisory firms to do its voting. And that's partially because AI can do everything that ISS and Glass Lewis did. You can just go into Grok and find out in 30 seconds what you just paid ISS or Glass Lewis $500,000 to tell you.
Well, tell us how Heritage is using its investment portfolio differently than these ESG activists.
I'm glad you asked. So when we first started doing this is our second year. The first year we filed 4 shareholder proposals. This year we filed 26. And it's interesting because when corporations meet with us for the first time about these shareholder proposals, they tend to be kind of cagey and nervous. They're expecting something hostile. They hear Heritage Foundation and they think we're coming in there to bully or something like this because they just heard whatever you hear on the internet. But then we get on there and the engagement becomes very friendly, and they realize quickly that, We're actually here to help the company help itself. We want to improve the company. We're not trying to turn every company into Chick-fil-A or Hobby Lobby. We're trying to make sure that the company adheres to its fiduciary duty, adheres to its core corporate purpose, understands the risk of ESG and DEI pressures, make sure that it is complying with all relevant laws. And when they realize this, the engagement process becomes very constructive. And in fact, we've seen some of these corporations say things along the lines of, thank you. Thank you for coming to us and helping push this side, because for years, we have only gotten pressure from one side, and we actually did not want to be doing X, Y, and Z, but there was nobody else telling us to stop. No shareholder, at least, telling us to stop. Mm. And all we needed was a shareholder to come in and tell us not to do it so that we could stop. And that's what we're doing. And it's great. So most of our engagements, there are a couple exceptions. I don't know whether I should throw them out or not. Amazon, Amazon is one of them, and Starbucks is another. But with those exceptions, most of our engagements have been very constructive and healthy. And I think we're doing great work with these corporations. And that's why we've actually withdrawn, as of today, 9 of those 26 proposals. And the withdrawal is not a sign of failure. It's a sign of success. It's a sign that we were able to meet with these organizations. They were able to prove that they've either already stopped doing what we were asking them to stop doing, or that they will stop doing it going forward. Our engagement with Meta was fantastic. We were telling Meta, you need to make sure you're not using Southern Poverty Law Center metrics, the hate group, the hate map in your policies and practices. And Meta bent over backwards to ensure that it wasn't doing that. And keep in mind that the Southern Poverty Law Center targeted Charlie Kirk's TPUSA shortly before Charlie Kirk's assassination. And there is a history of corporations relying on SPLC metrics to negative effect. I'll say one more thing about that, which is a lot of companies think they're not using SPLC metrics, but then they realize in the process of investigating whether they are or not, that they are using a firm called Benevity to do their charitable giving. And Benevity has, from what we can tell, a default screen. Maybe it's not default, but that prevents employee matching from going to companies that are on the SPLC hate map. So if I wanted to donate as an employee of a company that's using Benevity, if I wanted to donate to Alliance Defending Freedom or Family Research Council or something like that, I couldn't get the employee match because of the Benevity screen. Well, a lot of the firms that we're engaging are figuring that out, and they're just asking Benevity to drop the screen. And then Benevity drops the screen, and the companies say, hey, we want a good relationship with Benevity too. We like Benevity. They're providing a good service. We just don't want that screen. And if they just change it, then everything's great. And so they change the screen. Everybody's happy.
I've seen some articles that say that, kind of woke is on the return 2.0. We're seeing some activism in Minneapolis. Target actually has been very quiet on the activist side and the things that they were doing previously. And I know that some of the activists in Minneapolis have gone to the stores saying that basically being quiet is the same as supporting things that they don't, some of the immigration stuff that they are fighting over in Minneapolis. So, do you feel like because we're seeing some of these companies get more and more quiet, do you feel like they're realizing that neutrality is still better than the activism that they were doing?
I would hope so. I do know that ESG proposals are still very popular in Europe, and we have things on the horizon in Europe that are going to be incredibly expensive to United States companies, like the Corporate Sustainability Due Diligence Directive, which would require even American companies of a certain size to disclose not only their own internal ESG data, but the data of the companies they're doing business with, and then the data of all the companies all the way down the supply chain, it's going to be almost impossible to fully comply with that. And it's going to cost companies billions and billions of dollars to have to comply with that. Now, why is this also a moral issue? Well, and why is it that some of the bigger companies might actually lobby for increased regulation? Well, it's because the bigger the company, the more it can absorb those costs. Smaller companies can't afford to absorb those costs. And so they either have to go out of business or make serious cuts, and they're very affected. And that only makes the bigger companies get bigger. It actually eliminates the competitive playing field. And when you eliminate a competitive playing field, prices go up and consumers suffer. So these regulations that allegedly are for all these environmental things and to help society, well, all they do is they drive up costs. They make it hard for mom and pop shops, for small firms, even for smaller publicly traded companies to compete. And that harms everybody writ large.
Well, Alan, I think what you all are doing is fantastic. And I don't think people realize the tentacles of this and how deep they run and how they impact from people's ability to be fairly evaluated for potential jobs, to their investment portfolios, their retirement, and how this is truly affecting Americans. And so what you all are doing is so important. Can you tell our audience where they can go to find out more about this issue and how they can support it?
Yeah, thank you. We have a newly launched landing page on the Heritage Foundation website. It's just heritage.org. And we are the Free Enterprise Initiative. And it was the Capital Markets Initiative, but we did just change the name because our work has outgrown the scope of what we were doing before. We're focusing on all fundamental economic freedom, from property rights to entrepreneurship, competition, minimal bureaucracy. And the goal is to make our country more prosperous so that people can work, build, own, and innovate without having to ask Washington for permission. We want to empower the ordinary consumer, and we want to make lives better, more prosperous for everyone. So just Free Enterprise Initiative, Heritage Foundation. It's an easy way to find us.
Free Enterprise Initiative. I think you all should go there, take a look at what they're doing. It's so important, and it does affect every American. If you have a 401k or you want a job, it affects you as an American. Well, Alan, thank you so much for taking the time to join us on Main Street Matters, America's small business megaphone. Main Street Matters is part of the Salem Podcast Network. New episodes debut every Wednesday and Friday. You can subscribe to the show wherever you get your podcast from, and we'll be back soon with another episode. Bye for now.